Well, hi everyone. Welcome to the Buffett and Beyond ETF report, and this is for June 1st, 2024. And oops, is there a reversal in our top ETFs? Does that look like a big double top right there? And remember, folks, if you want to live on this beach like Jimmy Buffett used to live, you've got to learn how to invest even better than Warren Buffett invests now. And let us look at the Dow Industrials, and there we are. This is the double top that we've been looking at, and I want to look at this indicator up here because you can see that we go up to the top and then we come back down, and then we go back up to the top, and now we're coming back down again. And here we are. We might be testing this previous low here of about a month ago. And that's the 37,500, 37,600 or so, because this line right here is 38,000, and that's where we're sitting right now as I'm recording this, because the market is not closed. Then we come all the way down here, and we can see we are starting to get very oversold in the market. When we get oversold, you usually get a bounce back. But the Dow has been the weakest of all the averages, and this is what we're looking at right here. We don't want to go past that line there. Now let's look at the S&P 500, and the S&P 500 had its double top, but now here's something that's very, very scary. We can see that the market made a higher high, but this indicator down here made a lower high. Not a very, very good sign. And now we've got an all-out sell signal on the S&P 500. And it looked like it was going to be a little bit stronger today. I'm reporting this Friday afternoon. It looked like it was going to be a little bit stronger today, and then it just gave way and kind of fell apart. Now let's look at the QQQs, because we're interested in the QQQs because the ETF stocks that we have in our portfolios are mostly tech and semiconductors, and also home builders too, and that goes along with the economy. And that had been the strongest. I'm talking about the QQQs. This is the NASDAQ 100. Had been the strongest, and it was the last one to start to fall. And then yesterday and today, you can see that it took quite a tumble below the 20-day moving average, approaching the 50-day moving average, this blue line here. And we'll see what happens. But down here, now we have a sell signal on which was the strongest index out of the three that we're talking about, much stronger than the Dow. The Dow was the weakest, S&P right in the middle, and the QQQs was the strongest. And you can see how long it stayed up there before it finally gave way. Now, let's look at the housing industry, and here's something that I saw yesterday. And so we moved some stocks around in our ETF portfolio, which I'll talk about later. But right now, look at this home builders. I mean, we had a declining top, a lower top here, this right in here, and it was just starting to fall apart. And then all of a sudden, it stopped, and we got this little short-term buy signal. So this was Thursday, or this was Wednesday. This was Thursday. And so we got that signal, and now we're down just a little bit today. So what is the housing or the home building ETF trying to tell us that the rest of the market is saying, no, we're going down? And all of a sudden, this weak housing sector, which was fairly weak, and all of a sudden it said, we want to put it in the bottom here. So we'll see, folks. This is going to be very, very interesting. So these stocks have remained the strongest. Now, we want to show you something about, and we're going to go over the QQQs with hedging and with the timing of that hedging. So this is as of afternoon of Friday that I'm recording this. So we're actually recording this on May 31st, late afternoon. And remember, we took Tesla out of this portfolio, and it gave us almost a 30% loss, and we have to keep that loss in there. It's not like you can take a stock out of your portfolio and all of a sudden the loss magically disappears. No, it's got to stay there. So what we're looking at is timing the hedges or constant hedges. Now, when we say hedges, we're talking about hedging 30% of the portfolio. And you do that with an inverse ETF. Now, these inverse, and this is a 3-for-1 inverse. So if you put 10% in this inverse ETF, you get a 30% return, either down or up. And the reason they invented this is because so many people had IRAs. Well, just about 50% of the country have IRAs, and you couldn't hedge the IRA. So some smart people came up and said, why don't we buy an inverse ETF so we don't have to go short in the IRA? And that's exactly what happened. So the good thing is that we could use 10% of our portfolio and get a 30% bang for the buck. And the key is, do you want to stay hedged 30% of your portfolio all the time, or do you want to try and time those hedges? When the market goes up, you want to be out of your hedges. When the market goes down, you want to be in those hedges. And timing is tough. Don't let anybody tell you otherwise. All right, but let's get into this. And the thing that I want to bring out the most is why this hedging works so well with these ETFs is because we use clean surplus methodology, clean surplus analysis, which allows us to pick. And let's say you have any ETF or any index, whether it be the S&P 500, the Dow 30, and if you pick the better than average stocks in that index, you will mostly always outperform that index because you're leaving the bottom half or the below average stocks alone. Earnings drive the indices, drive the individual stocks, and the stocks make up the index. And therefore, if you pick the top half, and we go shorter than that, we say, okay, we want to pick the top 10% of the stocks. So why the hedging works so well is because even if you're hedged all the time, the stocks that we pick for our ETF portfolio, in other words, our top stocks in that ETF, you will outperform most of the time. And I say most of the time because all our research, and folks, we're going back 10 years, and then and then 5 years ago, we went back 5 years before that. Then 5 years ago, we picked the portfolios of the different ETFs, and all the stocks that we selected outperformed their respective ETFs. And so now we're doing it with live portfolios. And here we go. We picked the top 11 stocks. It had been 12 with Tesla, but 11 stocks now. And then we use the inverse ETF in order to hedge. So what has happened here since last week? Well, the market went down, and the QQQs are down strong yesterday and today. So last week we're down here. Okay, so these were the returns last week. So the last week the QQQs were up about 10%. It doesn't show it here, but they were up about 10%, and our stocks were up 24.7%. Not hedging, nothing, just we picked the top stocks, and we're more than doubling the QQQs. So what happened this week with the market that went down? Well, the market went down, and our stocks went down, and so now we're up 20.9%. Let's call it 21%. Well, that's 2.5 times the S&P 500 and more than 2.5 times the QQQs, which is the ETF that these stocks come from. So in other words, we're still staying true to our methodology. We pick the best stocks, and we're outperforming the index, and of course we want to outperform the S&P 500. Why? Because over any 10-year period, 96% of professional money managers who manage the publicly traded mutual funds, 96% of them cannot outperform the S&P 500 over any 10-year rolling period. And that's a report that came out almost 20 years ago, and it holds true to this day. So we want to be able to take some of the volatility out of this stock portfolio. And we've gone over that in the past, and we researched 30% hedging. So you can take 10% of this portfolio value, and because it's a 3-to-1 inverse, we actually are insuring 30% of the portfolio. So if we're hedged all the time, 30% of the portfolio, we have lost 6.6%, but we were in the best stocks. So if we lost 6.6% there, but we gained, and let's go back to last week's number, we gained 24%, well, we should be up about 16%, which was the S&P was up about 10 point something percent last week, and we were still outperforming the S&P 500, but we were cutting down the volatility. Now, what if we timed those hedges? Well, instead of being down 6.6% by being hedged all the time, we would actually be up 9.2% for the year because we timed our hedges. In other words, at the top, we buy our hedges. Then when we see a bottom in the market or think we see a bottom in the market, we get rid of those hedges and we go long the QQQs because it's primarily the best of the QQQ ETF. So because of the past couple of days, we have gained, because of our timing, we've actually gained for the year 9.2% just on timing the hedges. So going short when the market went down and going long the QQQs when the market went back up. So we're doing well on the hedge, on timing the hedges this year, and that doesn't always work very well, folks, because sometimes the market goes up and your hedges go down. But right now we're doing very well on the timing, and these past couple of months have been relatively good signals that we've gotten. So if we're hedged all the time, we're down just on the hedges now. We're down 6.6%, but if we're timing those hedges, we're actually adding 9.2% to a third of the portfolio. So these numbers in here are worth about 30% of the entire portfolio. So since the market has gone down, this is last week's in here, last week's numbers. This is this week's numbers. So our stocks went down about almost 4%. In here. Now, what about our hedging? Because our hedging went up in the timing part of it, so we actually gained in here a little bit. But if we were constantly hedged, we lost in there, and so we lost in here. But those of you who want to be constantly hedged, what's your goal? Your goal is to outperform the S&P 500 and reduce the volatility of this portfolio to something less than the S&P 500. So let's get that straight. By being hedged about 30%, well, and we're using 10% of the money because it's a 3-for-1 inverse, we're actually hedged by 30% of our portfolio. We cut down the volatility of the portfolio below the S&P 500, but yet we want to be able to outperform the S&P 500, and that means we're outperforming over 96% of the professional money managers out there. And if we want to time those hedges, we're doing really well. So down here, if we're hedged all the time, we're up 12.9%, with the S&P up 9% and the QQQs themselves up 8.3%. So if we're hedged all the time, we're very nicely outperforming both the QQQs and the S&P 500. If we're timing the hedges, we're doing very well. And if we're just holding these stocks and letting them do what they're going to do, we're up 20.9%. But if we're timing our hedges, we're actually up 21.3%. Very, very nice. So right now, timing the hedges and using the SQQQ, which is the 3-to-1 inverse ETF, which was designed for IRA, designed for the qualified money portfolios, we are ahead of the game right now. So do we care if the market went down? Well, in this instance, no, we don't if we have this portfolio. Now, we didn't go over the All-Stars portfolio that we have, which is consisting of about 21 stocks, because we changed some of the stocks today. We introduced 3 more of the housing stocks. Why? Because the housing index is showing strength in the down market. Okay, so if we're going to do any changes and get into some of the housing stocks, we'll sell some of our other stocks and get in the housing stocks, which we did today, so we don't have fair returns on the portfolios because of what we did, or I should say what the money managers who follow this strategy, what they've done with their portfolios, because we are not money managers, we are research people, and we put out our research to professional money managers, and they subscribe to that. But they're doing very, very well in there. Now, a lot of you say, hey, I don't get these same numbers that you get. This is because with all the research that I have done and the books that I have written, all these stocks are equally weighted. And there was a portfolio group that was out some years ago, and they were bought out, but they would allow you to buy fractional shares. So you could put, if you had 10 stocks, you could put 10%, exactly 10% of the portfolio value into each stock. But they didn't deal with options, and we didn't even have the inverse ETFs when that company was before it was bought out. But we used to use it for our portfolios because our whole theory and all our research, and we have 22 years of actual portfolio results, folks. And yes, accountants have looked at those numbers and they've said, yeah, your numbers are correct. So we are looking at putting exactly the same amount of money into each stock. Well, it's hard to do it when you have Broadcom at $1,116, and then you have Advanced Micro Devices at only $147. So it's hard for smaller portfolios to be exact. Other company that I was talking about that was bought out, you were able to do that. And we had some small portfolios that we used to report on managing, and it had exactly the same amount of money into each stock. And what was good is that if you added, say, $100 a week, you could tell the portfolio, through the computer, of course, tell the portfolio, I want to invest $100 equally into each of 20 stocks or 30 stocks, whatever you want. And they would put buy fractional shares and put a few cents into one stock, a few cents into another stock, or a few dollars into that stock, and they were able to do it. So this is why you don't get the exact numbers that we do, is because you are not balanced the way that we are. When we say here, this stock or any one of these stocks is exactly, say, 15% of the portfolio, it's exactly 15% of the portfolio. Where in the live portfolios, you won't be exactly 15% in that portfolio because the stocks are all different prices. So I hope that answers that question there, folks. But bottom line is the market's going down. The housing sector is holding its own, and we are holding our own in here because from last week, we only dropped 1%. While the market has declined quite a bit in here, folks, about 4 or 5% on some of the indices. So we're doing very, very well with the timing of the hedges, and we're thankful we're catching those. And the people that are constantly hedged all the time because they don't want to worry about the timing of it and thinking about it all the time, you're doing better than the S&P 500 when it comes to volatility and when it comes to return. You can't beat that, folks. Well, you could beat it if the timing works. But it's a long year, folks, and we'll see what happens. We've had a tough week this week, folks, and the Dow has had its worst week in since the beginning of the year or in a year. So yeah, the Dow's not doing very well this week, and it's just sad out there, but don't worry about it because those stocks will come roaring back one day. And don't forget, the Dow is pretty much oversold, so don't worry about it. We give it, one of the timing services gives it another 2 weeks of declining market, and then we'll be coming back with a nice rally. So go out, enjoy the beach, enjoy the golf course, wherever you want to do. Go walk, go watch television, be with your family. And folks, the market will be here next week and be open on Monday, and we'll be right back here with you folks. So go out, stay safe, and we'll see you in a few days.